welcome to Economy and Markets TV, where we have conversations with a purpose. I'm your host, Dave Okenquist, Senior Research Analyst here at Dent Research. Joining me to take you around the world of economic and financial news and covering each topic in 2 minutes or less at my discretion is the editor of Boom and Bust, Mr. Rodney Johnson. Rodney, how are you?
Good, Dave. How are you?
I am great, Rodney. Great to talk the news with you and have you here each and every week. I know everybody loves seeing your takes on the news and breaking things down. Rodney, last week, everything was all about the Fed, and this week we're in a little bit of a holding pattern because we have U.S. GDP coming out next week for the second quarter, and just a bit of hint of what might come was released this week, which was retail sales. Those jumped 0.4% in June, above expectations. Seemingly strong report. Now, last week, Rodney, we also talked about the Red Book retail index, something that we don't normally mention, but it seemed to indicate some strength for this report. That was up 6.2% for the year. What's your take on this report, Rodney?
Well, that's exactly what we thought, given Red Book last week, which is why we mentioned it. It showed that we were going to get strong retail sales this week, which we did, which tells us we're probably going to get a stronger GDP number next week than we had originally forecast. And to that point, you know, we saw sales up pretty good across the board. A couple of things held it down. Gasoline held it down because energy prices were a little bit lower. Department stores held it down, you can say, because department stores continue to kind of trend lower, but that's made up on the e-commerce side. So it's not even a wash. E-commerce was doing better. But the Atlanta Fed GDP Now model bumped from whatever it was, 1.4, 1.5, up to 1.6 for second quarter GDP. And if that holds, that'll put us at about 2.4 for the first half of the year. Not great, not terrible. It's kind of middle of the road. But it's not that, kind of breakout running to the moon GDP that, a lot of people had said, hey, this is going to happen given the tax cuts. But the tax cuts had an effect. I mean, we put more money in the coffers of companies for profits. We also bumped the deficits. I mean, this is something that's going to come up probably by September when we get closer to the end of the fiscal year. We went from a roughly $600 billion deficit to what is now a $1 trillion deficit because of tax reform. What did it get us? Couple of, tenths of a percent of GDP. Was it worth it? Everybody gets to decide for themselves. But I think that's what we're going to see next week when we have GDP come out.
Is this the equivalent of all I got was this T-shirt?
It's something I've written since the tax reform went through, which is I did not see it pushing great GDP growth, but it was certainly going to add to the deficit. It's come true in a way that's disappointing because, all you get is the T-shirt. And it rearranges the pieces on the chessboard, but it doesn't make the chessboard bigger, that kind of thing. Yeah. And so I'm not, for what it's worth, it doesn't look like it's going to help us in the way that we were optimistic and hopeful that it might.
Yeah, absolutely. Rodney, let's turn our attention to the housing market. We got a bit of a report on housing starts and permits. Starts fell just under 1% for the month. Permits also dropped 6.1%. Just looking under the hood and some of the details here. Just in terms of year over year, because that's sort of sometimes a better measure because this month to month are very volatile. Starts were up 6.2% for the year. Single families down nearly 1%, while multifamily surged 25%. Those were housing starts, beginnings of building. On the permitting side, looking at what might be coming in the future, in total, down 6.6%, and then multifamilies down 10.2% year over year, and single families down nearly 5% for the year in terms of permitting. So what's coming down the pipeline doesn't look so hot, does it?
It doesn't, and it speaks to the same thing we've talked about for a year now, which is the plateauing in housing in terms of the industry growth. Supply has been constrained really, for 7, 8, 9 years, and so that's been the same story. A lot of apartments were coming online, as you mentioned, 24% rise in apartment or multifamily starts.
Right.
And so that makes a good case as to why you would have lower permits because you have so much inventory that's kind of already in the pipeline. It's the single family that's the weird one. We have so many more people that want housing, and yet we're not creating new supply. And so what's the holdup? I think it goes back to what we've talked about for a long time. The demand is at the lower end, but it's very hard to create single family housing near urban centers for that price point because of land price, regulatory price, materials, labor, all the things that go into it. So it pushes builders into multifamily instead, which makes all the sense in the world. And now that's kind of reaching a limit. So I think overall we're seeing what we've talked about for a long time here, which is the plateauing of housing. Supply constraints aren't helping. We're seeing prices come down, something we'll keep watching through the year. I wouldn't be surprised to see prices go a bit negative as we get closer to the end of the year.
Thanks, Rodney. Rodney, as the U.S. and China continue to negotiate the terms of the trade war, sometimes we get good news and then bad news. Companies aren't waiting around for them to figure this thing out. So we got some news from Apple that they're moving part of their AirPod production. Those AirPods are those white earbuds you see people wearing, moving a portion of that into Vietnam. This is not the first news of this sort that we've seen. And the question that I have is, is this gonna be a trend where companies are gonna be like, we need to get some certainty, and if that means just forgetting China a little bit here, that's the way we're gonna move.
Yeah, I think it's speeding up something that was already happening. The Chinese market for manufacturing was very cheap 20 years ago. And so a lot of people were moving there. They were able to create huge supply chains. And so you kind of had everything that you could do there in just a fraction of the time that it would take to put it together anywhere else. And so it made a lot of sense to build there. But over 2 decades, of course, their prices increased, particularly labor. And so it kind of told companies that, hey, if you want to keep that competitive pricing, you need to look at areas that have lower labor costs. And it was the up and coming economies of Vietnam and Thailand and Cambodia and others that are still close enough to China to benefit from that supply chain, but do give you that cheaper labor price in some areas. And I think the tariffs are just kind of speeding that up.
Yeah.
The problem companies have is they don't want to annoy the Chinese so much as the Chinese start looking at them saying, hey, what are you doing here? And so it's called the China Plus One strategy, where you do your stuff in China, but you add one more little thing over here to manufacture, and perhaps you put all your new stuff there. So you're not lowering what you do in China in a measurable way, but you're putting all your new somewhere else to diversify some, certainly get away from the tariffs, and just kind of make sure that you got your bases covered in case anything weird happens in the future.
Now, this is sort of that race to the bottom concept, isn't it? So Vietnam could be the new China, maybe Laos, maybe the moon.
You keep moving to the lowest cost producer in terms of labor, because who wouldn't? As long as you can move the capital and the goods around the world, then you as a producer are better served to do that. And your consumers arguably are better served because they get a lower priced product and can use more of their dollars to buy other things. So it's the old Adam Smith specialization of labor argument. Whether you fall on whichever side you fall on, it is that argument. And so just moving from China somewhere else, very natural progression.
Yeah, absolutely. Rodney, we are in earnings season, and Netflix reported their earnings showing weak subscriber growth. And on news of that, the stock fell 11%. Now, they were expecting, they gained 2.2 million subs internationally, but they expected a 5 million growth, so definitely disappointing. And U.S. subs went down, contracted. And some of this is being blamed on the price increase and a bunch of other things. What do you think is going on with Netflix?
It's a couple of things. I mean, Netflix has a difficult job in their forecasting as to what's going to happen because how much international subscribers, log on or subscribe to their system depends on a lot of things. One, if it's a foreign language, you have to have foreign language content that they want to see. Right. And so they have to create a lot of content now in other languages, which they do, that has an appeal to other markets, right? It's other sociabilities, other cultures. And so they got a lot of things that are kind of working on them. And so being able to forecast that correctly seems like a very difficult job. They also have a lot of subscribers. I mean, it's a big company, right? And so you look at it and say, they've got over 100 million people that are subscribing to it. I don't know what their possible top end is, but they've got competitors coming on. Yeah. I find very interesting in the whole thing that it's earnings season and we don't talk about their earnings. We talk about their subscribers. I would wonder how many people know how much money Netflix actually put to the bottom line from their earnings. And the number, which actually I don't even know, I know it's minuscule because they put so much money back into new programming. It points out that these companies that have almost zero or even negative earnings are all about the expectation. And when that growth expectation psychology or forecast changes, it can change the fortunes of the company dramatically. And so that's That's really a weird tipping point thing we have going on with a lot of these companies that are big names now. The Ubers that are out there, WeWork is coming on the market, Beyond Meat loses money. And so I think we should be watching these. They were unicorns, but now they're public companies with near negative or negative earnings, and asking ourselves, are they really worth the big valuations we've given them?
Now, Ronnie, I don't know if you're a Netflix subscriber or not. I actually was. I'm one of these people who dropped off, in part because of the price increase. I upgraded to the 4K package, and then the price went up, and it was somewhere near around $20. And I said, you know what? Not for me anymore. And it actually wasn't just the price, it was the content. I noticed over the last, I would say, year and a half, this shift to original content, which I found to be lacking. And it's just entirely not for me.
We're Netflix subscribers. We don't watch it often because what we found ourselves watching now is Amazon Prime. Amazon Prime has picked up some more of the shows that we liked from 7-10 years ago. And it's like, oh, you go find it again and kind of watch it some. We have retained the Netflix, not because we watch it, but because our kids still watch it. And so, you know, my kids in their 20s are still using our login. And, you know, it is what it is. But they also use the Amazon Prime, although I'm told, again, by my children, that Roku is a much better deal if I want to deal with any of this. And so they're trying to get me out of the 2000s and into the 2010s by moving away from Netflix, which, of course, you already have.
Yeah, absolutely. And Amazon Prime for me as well. And I also have, well, we're just talking about my viewing habits, but I also have Hulu, which is bundled with our Spotify premium subscription. We have the lowest tier, which gives us everything we need. So we're definitely, I think really the point here is I think we're going to see a shakeout in this streaming thing as we see more come out. And actually Netflix is losing their the most watched program. The Office is going to NBC Universal's own streaming program, as well as Friends, I believe. So it's going to be, can Netflix really hang on their own programming, I think is going to be the big question.
It is, and they can, but they spend all their earnings doing it. And so if you spend all your money creating the content, you have nothing left over for your shareholders at the end of the day, and that is kind of the question.
Yeah, that's some good TV talk, Rodney. That's all we have for this week. Looking at the next week, we're going to have releases on new and existing home sales, durable goods, and of course, as we mentioned at the top, all eyes will be on second quarter GDP. That comes out Friday morning, and we will report on that as we do each and every Friday. Rodney, what else do you have your eye on next week?
Well, I'm still watching earnings. I mean, we just started getting some companies in. It's still supposed to be negative here. And so I'm still watching companies to see what they're going to tell us. And remember, when interest rates go lower, banks earn less. And so we've watched banks come in with some negative reports here. Yeah, maybe they earned a little bit more on some consumer side, but they lost a little on trading. If you see their net interest margin come down as interest rates come down, it could be tough for the financial sector over the next several months or even year.
Yeah. And I want to thank all of you watching for sending in your questions and comments. We didn't get to one today, but maybe we can do so next week. I'd love to hear your thoughts on the markets, Netflix, streaming service, whatever you have your eye on. Send those to tv@economyandmarkets.com, and we'll read them on the air. For Rodney Johnson, I'm Dave Okenquist, and this has been Economy and Markets TV.